Michael Turner had checked his retirement account almost every Tuesday morning for the past 12 years. Not obsessively, not nervously, just carefully. He was not a day trader. He was not chasing hot stocks. He did not even enjoy looking at the market. But after 36 years working at the same manufacturing plant in Dayton, Ohio, that number on the screen was not just a balance. It was freedom. And on that Tuesday morning in early March, with exactly 9 months and 11 days left until his planned retirement date, Michael opened his laptop the same way he always did. Coffee first, glasses on, log in. The house was quiet. Linda was still asleep upstairs. She had retired 3 years earlier after working as a public school administrator. They had done the math carefully. They had waited. They had planned. Michael typed in his password. The page took slightly longer to load than usual. He noticed that. A small spinning circle. Then the dashboard appeared. For a moment, his mind refused to process what he was seeing. Total account value, $11,243.17. He blinked. That was not possible. The previous Friday, before the weekend, the balance had been $847,000 and change. He remembered it clearly because he had calculated it against their projected retirement income. He had even shown Linda. See, if the market just stays steady, we're fine. He refreshed the page. The number did not change. He logged out. Logged back in. The same number, $11,000. Michael felt something shift inside his chest. Not sharp pain. Not yet. More like a hollow drop. The kind you feel when your car slips on black ice and your stomach lags half a second behind reality. He opened the transaction history. There were pages of activity he did not recognize. Liquidations, transfers, internal reallocations, redemptions, dates from the past 3 weeks. He had not touched the account. He never touched the account. His retirement strategy was structured, disciplined. Automatic contributions, quarterly reviews, annual calls with his advisor. He reached for his phone. 8:12 a.m. Too early to panic, he told himself. This had to be a reporting glitch, a system error, a temporary display issue. Financial institutions had safeguards, regulations, insurance. You do not just lose $800,000, not in a retirement account, not after doing everything right. He dialed his advisor's direct number. Voicemail. Hi, this is Daniel Brooks. I can't take your call right now, but leave a message. Michael ended the call before the tone. He tried the main office line. An automated menu answered. Due to higher than normal call volume. He pressed 0 repeatedly. Nothing. His hands were colder now. The coffee in front of him sat untouched. Upstairs he heard movement, the shower turning on. Linda would be downstairs soon. He opened the account details again, slower this time. The funds they had been invested in, the ones labeled Protected Growth Allocation and Income Shield Strategy, were showing massive redemptions, transferred into something called Capital Preservation Holding. He did not remember approving that. He clicked deeper. A notification banner appeared at the top of the screen. Important update regarding fund liquidity measures. He read the paragraph twice, but the words would not settle. Temporary restrictions. Market volatility. Stabilization protocol. The language was calm, clinical, vague. He dialed Daniel Brooks again. Voicemail. This time he left a message. Daniel, it's Michael. I'm looking at my account. Something isn't right. Please call me back as soon as possible. He tried to keep his voice steady. He did not succeed. He stood and walked to the kitchen window. The backyard looked unchanged. Frost still clung to the grass. The wooden fence needed repainting. A bird landed briefly on the railing. The world had not shifted, but something inside it had. He heard Linda's footsteps on the stairs. Good morning, she said gently. He could not answer. She stepped into the kitchen, tying the belt of her robe. You're up early? Everything okay? He turned the laptop toward her. I think there's a mistake. She leaned closer. What am I looking at? That's the retirement account. She frowned slightly. No, it isn't. He nodded once. That's what it says. She waited for the explanation, for the correction. When it did not come, she leaned in closer. She saw the number, $11,000. Her face did not change dramatically. It was slower than that. A tightening around the mouth, a pause behind the eyes. That can't be right, she said quietly. I know. Refresh it. I did. She straightened. When did this happen? I don't know. When did you last check? Friday. And it was normal? Yes. How does it drop $800,000 in 4 days? He had no answer. Linda sat down at the table slowly. Neither of them spoke. The silence was not loud. It was heavy after a long moment. She asked the question Michael had been trying not to form in his own mind. Is it gone? His throat tightened. I don't know. He hated those words. For 36 years, he had been the steady one. The planner. The one who stayed at the same company when others jumped ship. The one who increased contributions when co-workers bought boats. He had skipped vacations during the financial crisis, increased contributions during downturns, trusted the process. He had believed in compound interest, long-term strategy, professional advice. You do not get wiped out when you play by the rules. His phone buzzed. Unknown number. He answered immediately. Hello? A recorded message began playing about extended warranty coverage. He ended the call. Linda's voice was softer now. What are we going to do? That question landed harder than the number on the screen. Because numbers can be errors. But that question assumes reality. We wait, he said finally. It has to be some kind of hold or reporting delay. He was not convincing her. He was not convincing himself. By mid-morning, he had called the advisory office 6 times. At 9:42, an email arrived. Subject line, update regarding strategic reallocation measures. He opened it immediately. The language was calm, reassuring, carefully worded. It mentioned volatility event triggers and defensive capital conversion. It did not mention loss. It did not mention recovery. It did not explain why his retirement date was 9 months away with just over $11,000 remaining. By mid-afternoon, Daniel Brooks returned the call. Michael stepped into the garage to take it. Michael, Daniel began, his tone controlled. I expected some calls today. Tell me what happened. It's a temporary liquidity protection measure. Why is my account at $11,000? It isn't gone, Daniel said quickly. It's repositioned. Repositioned where? There was a volatility trigger. The strategy moved into capital preservation. Michael leaned against the wall. When does it move back? A pause. That depends on market stabilization. How long? Hard to say. Michael closed his eyes. How much did I lose? Another pause. On paper, about 82%. The number did not register immediately. 82%. That's not possible, Michael whispered. It's a structured defensive product, Daniel replied. These are extreme conditions. Michael looked at the concrete floor of the garage, at the oil stain near the front tire, at the plastic bins filled with Christmas decorations. Normal life? 82% gone. I was supposed to retire this year, he said quietly. There was no answer to that. After the call ended, Michael remained in the garage for several minutes before returning inside. Linda looked up immediately. He shook his head once. She understood. That night, neither of them slept. Around 2:30 in the morning, Michael went downstairs and opened the laptop again. He stared at the number. Just over $11,000. It did not feel real, but it was. And what Michael did not yet understand, what would take weeks to piece together, was that the collapse had not started this month. It had not started last year. It had started 12 years earlier, with a decision that sounded safe and a signature he barely remembered giving. Before the phone calls, before the email, before the number dropped to just over $11,000. There was a man who believed he had done everything right. Michael Turner was 22 years old when he first walked through the doors of the Dayton Industrial Components plant. It was August, humid, loud. The kind of heat that clung to your shirt before 8 in the morning. He had not planned to stay there for 36 years. No one ever does. It was supposed to be temporary. A stepping stone. A way to earn steady income while he figured out the rest of his life. But the job offered benefits, real benefits, health insurance, a pension track, and, later, a 401k plan with employer matching. Older men on the floor used to talk about it during lunch breaks. Max it out, one of them told him during his first year. You won't miss what you never see. At 22, retirement felt abstract, distant, almost imaginary. But Michael listened. He enrolled early. At first, he contributed 3%, then 5%, then 10%. When he received a raise at 29, he increased the contribution instead of upgrading his car. When Linda suggested a bigger house in their early 30s, he asked a different question. Do we need it? They chose smaller, practical, affordable, not because they were afraid, Because they were disciplined. During the market downturn in the early 2000s, co-workers panicked. One man pulled everything out and moved it to cash. Another stopped contributing entirely. Michael did neither. He attended the company's retirement seminar instead. He sat in the second row, took notes, and asked about long-term projections. The presenter showed charts. The market goes up. The market goes down. Over time, it trends upward. Compound growth rewards. Patience. Stay invested. Trust the system. Michael believed that. When the financial crisis hit in 2008, it tested him. The account dropped sharply, nearly 40% at one point. Linda asked if they should reduce contributions. He shook his head. If we sell now, we lock it in. They tightened spending instead. No vacations that year, no major purchases. He increased contributions when the market was down. He told himself it was buying shares at a discount. By 2011, the recovery had begun. By 2013, the balance had surpassed its previous peak. By 50 years old, Michael's retirement account had crossed $500,000. He did not celebrate publicly, but he felt something quiet and steady inside. Relief. Proof that patience worked. He never chased individual stocks. He never invested in anything he did not understand. He avoided speculative trends. When co-workers began talking about technology startups and cryptocurrency years later, he listened politely, then went back to his diversified portfolio. His strategy was simple. Diversify. Rebalance. Contribute consistently. Retire at 59 and a half. He had circled that age on a calendar once as a joke. Freedom Day, he called it. Linda laughed. She retired at 60. They ran projections together at the kitchen table. Spreadsheets, printouts, conservative assumptions. If the account reached $800,000 and they withdrew 4% annually, combined with Social Security, they would be comfortable, not extravagant, comfortable. No mortgage, no debt. A modest home near the water in North Carolina. Morning walks, long breakfasts, maybe volunteering. It was not a fantasy of luxury. It was a vision of stability. By 56, the account balance hovered near $700,000. By 57, it crossed $800,000 for the first time. Michael began checking it more often, not because he was worried, because he was close. 9 months before retirement, it had been just over $840,000. That number represented 36 years of restraint, 36 years of saying no when it would have been easier to say yes. He did not inherit money. He did not win anything. He built it slowly, methodically, and that was what made the collapse so disorienting. Because reckless behavior explains disaster. Gambling explains disaster. Greed explains disaster. But discipline is supposed to protect you. The year he turned 46, a representative from his retirement plan provider offered complimentary portfolio reviews for long-term participants. Michael scheduled one. That meeting would become important later. But at the time, it felt routine, professional, responsible. The advisor assigned to him was Daniel Brooks, mid-40s, confident but not flashy, calm voice, crisp suit, spoke in measured tones. Daniel reviewed Michael's allocation and nodded thoughtfully. "You've done well," Daniel said. "Very disciplined." Michael felt a small surge of pride. "But," Daniel continued gently, "you're approaching the stage where downside risk matters more than upside growth." Michael listened carefully. Daniel showed him charts. If a major downturn happened 5 years before retirement, it could delay his exit by several years. Sequence of returns risk, volatility exposure, protection strategies. The words sounded technical, but reasonable. Michael did not want higher returns. He wanted safety. Daniel framed it simply. "You've built the mountain," he said. "Now we protect it." That made sense. Michael had no interest in chasing more growth. He wanted stability, security, assurance that a market crash would not erase decades of effort. The shift Daniel proposed was not dramatic. A gradual reallocation. A portion moved into structured funds designed to limit downside exposure during extreme volatility. There were brochures, graphs, back-tested performance scenarios. In most of them, the strategy slightly underperformed during strong bull markets, but it significantly reduced losses during crashes. "That's the trade-off," Daniel explained. "You give up a little upside for peace of mind." Peace of mind. That phrase stayed with Michael. He did not make the change immediately. He went home, discussed it with Linda. "Does it sound risky?" she asked. "No," Michael said. "It sounds safer." A week later, he signed the documents. He did not rush. He read portions of the paperwork, but much of it was dense, legal, technical. There were sections about liquidity conditions and trigger events. They did not seem urgent. After all, the entire purpose was protection. The account shifted gradually over the next year. Performance remained steady. Nothing dramatic, no red flags, no alarms. For more than a decade, Michael believed he had strengthened his retirement plan. He believed he had reduced risk. He believed he had acted responsibly, and in many ways, he had. But what Michael did not yet understand was this. Protection strategies are built on assumptions, and assumptions fail under pressure. 12 years earlier, the decision had felt conservative, measured, prudent. He was not chasing returns. He was guarding against disaster. But sometimes, the thing designed to protect you is the very thing that locks you in place when the storm hits. And 9 months before retirement, Michael Turner would learn exactly how that felt. It was late October. 12 years before the morning, the account collapsed. Michael Turner still remembers the parking lot. Rows of identical sedans, clean glass building, a modest brass plaque near the entrance with the firm's name engraved in understated lettering. He had taken a half-day off work for the appointment, not because he was worried, because he believed that was what responsible people did. Inside, the office smelled faintly of coffee and new carpet. Framed certificates lined the walls behind the reception desk. Awards, accreditations, professional affiliations, stability, presented in mahogany and glass. Daniel Brooks greeted him with a firm handshake. "Michael, good to see you again." They had spoken once before on the phone. This was their first in-person review. Daniel led him into a conference room with a wide table and a wall-mounted screen. A legal pad sat neatly aligned in front of each chair. Michael appreciated details like that. Preparedness. Order. Daniel opened a folder. "I've reviewed your allocation," he began. "You've built something solid." Michael nodded, slightly uncomfortable with praise. "But," Daniel continued, tapping a chart on the screen, "you're entering a different phase." A graph appeared. 2 lines moving across decades, one steady, one volatile. "When you're young, volatility works in your favor," Daniel explained. "Time absorbs shocks. But as retirement approaches, the sequence of returns matters more than average returns." Michael had heard the term before. Sequence risk, the danger of a downturn right before retirement. Daniel clicked to the next slide. "What happens if the market drops 30% the year before you retire?" The line on the screen dipped sharply. "It could take years to recover. You don't have decades anymore." That sentence landed quietly. "You don't have decades anymore." Michael was 46 at the time. Retirement still felt distant, but not abstract. Daniel shifted the presentation. "There are strategies designed specifically for this stage," he said. "They aim to limit extreme downside events." He used phrases like capital preservation, structured downside buffers, volatility-triggered reallocations, defensive overlays. The language was technical, but not alarming. If anything, it sounded intelligent, sophisticated. Michael leaned forward slightly. "What's the trade-off?" he asked. Daniel nodded approvingly. "You give up some upside during strong bull markets," he said, "in exchange for protection during severe downturns." Michael considered that. He did not need maximum growth. He needed reliability. Daniel clicked again. A comparison chart appeared. On the left, a standard diversified portfolio. On the right, the proposed protected growth allocation. In steady years, the protected version underperformed slightly. In crash simulations, it showed smaller losses. The difference was not dramatic, but it was noticeable. Daniel pointed to a highlighted section. "If something like 2008 happens again, this structure activates defensive mechanisms automatically." Automatically? Michael liked that word. He had built his entire financial life around automation. Automatic contributions, automatic rebalancing, automatic discipline, emotion removed. Daniel continued. "These funds use preset triggers. When volatility spikes beyond certain thresholds, they shift exposure into capital preservation vehicles." "What does that mean exactly?" Michael asked. "Cash equivalents, short duration bonds, low correlation instruments." It sounded reasonable, measured, professional. "Can I lose everything?" Michael asked directly. Daniel did not hesitate. "No. The design is specifically to prevent catastrophic loss." That sentence would echo in Michael's mind 12 years later. Prevent catastrophic loss. The meeting lasted nearly 90 minutes. They reviewed fee structures. Daniel explained management costs. There were percentages, layered expenses. Michael understood that advisory services were not free. The total fee was higher than his previous allocation, but not alarmingly so. And if it reduced risk, it seemed justified. Before leaving, Daniel handed him a packet, detailed prospectuses, risk disclosures, liquidity terms. Michael took them home. He placed them on the dining table that evening. Linda glanced at the stack. That looks complicated. It is, Michael admitted. But it's supposed to make things safer. They discussed it briefly. Linda trusted his judgment. She always had. Michael flipped through sections of the paperwork. He read summaries, skimmed charts. Some pages described temporary liquidity restrictions during extreme market stress. Others referenced structured notes and derivative overlays. He paused at one paragraph. In certain rare conditions, fund redemptions may be subject to timing adjustments to preserve overall strategy integrity. He frowned slightly. What does that mean? Linda asked. Probably just legal language, he said. Everything has disclaimers. He was not careless. He was not reckless. He simply trusted that safeguards meant protection. The next week, he returned to the office to sign. Daniel walked him through signature lines calmly. Just acknowledging you understand the allocation shift, Daniel said. Michael signed where indicated, initialed where required. He did not feel pressured. He did not feel confused. He felt responsible, like a man reinforcing the foundation before the storm season arrived. Over the next year, the reallocation occurred gradually. Quarter by quarter, portions of his portfolio shifted into the structured strategy. Performance did not spike. It did not collapse. It simply moved more quietly than before. During strong market rallies, co-workers bragged about double-digit gains. Michael's account grew more slowly, but steadily. Daniel framed it as discipline. We're trading excitement for stability, he said during annual reviews. Michael was fine with that. He did not want excitement. He wanted certainty. Over time, the details of the paperwork faded from memory. The phrases, the footnotes, the liquidity clauses, they became background noise. For 12 years, nothing dramatic happened. Markets rose. Markets dipped. The strategy adjusted quietly behind the scenes. Michael slept well. Until the morning it didn't. What he could not see back then, what no chart on that office screen fully illustrated, was how those automatic defensive mechanisms functioned under extreme stress. They did not simply protect. They reacted. They moved fast. And once triggered, they followed rules that did not consider individual retirement dates, or 9-month timelines, or porch swings in North Carolina. 12 years earlier, Michael believed he was reducing risk. What he had actually done was accept a different kind of risk, one buried in structure, hidden in language, activated by conditions he assumed would never align at the worst possible moment. And when they finally did, the system did exactly what it was designed to do, not what he expected it to do. Looking back, Michael Turner would later say, the collapse did not feel sudden. It felt sudden on the screen, but not in the weeks leading up to it. There had been signs. They just did not look like warnings at the time. 3 weeks before the account dropped to just over $11,000, Michael noticed something small. The balance had dipped faster than the broader market. He followed major indexes casually, not obsessively, but enough to recognize patterns. If the market dropped 2%, his account might drop 1.5%. That had always been the trade-off. Less upside, less downside. But this time, during a modest pullback, his account dropped nearly 4% in a single week. He told himself it was timing. Maybe the update lagged. Maybe dividends had not posted yet. Maybe it was normal variation. He did not call Daniel Brooks. He had learned not to overreact to short-term movement. That was part of being disciplined. A few days later, he received an automated email notification. Portfolio adjustment completed. He almost deleted it without opening it. Rebalancing happened periodically. It was expected. Still, he clicked. The email was brief. In response to elevated volatility metrics, your allocation has been adjusted in accordance with your selected strategy. He did not fully understand what that meant. But the phrase, in accordance with your selected strategy, reassured him. This was what he had signed up for. Protection. Later that evening, Linda mentioned something she had seen on the news. They're saying markets are jittery again, she said. Something about bond yields. Michael nodded. It'll settle. He believed that, because it always had. A week later, he logged in again. The balance had fallen further, not catastrophic, but sharper than usual. 790,000, then 765, then 730. The market headlines were dramatic, but not apocalyptic. No full-scale crash. No historic meltdown. Just volatility, the kind the strategy was supposed to manage. He checked the fund breakdown more closely this time. The protected growth allocation portion had shifted heavily into something labeled Capital Preservation Holding. Nearly 60% of the account now sat there. He frowned. That seemed high. He tried to remember if that percentage had ever been that large before. He could not. There was a link beside the holding. Liquidity conditions apply. He clicked it. A dense paragraph appeared, referencing temporary redemption timing structures during extreme volatility clusters. He read the first 2 sentences, then stopped. It sounded procedural, temporary, protective. He closed the window. The following Monday, the market rebounded slightly. Major indexes recovered 2%. Michael logged in, expecting to see at least partial recovery. The account barely moved. $728,000. He refreshed. No change. He opened the transaction history. More reallocations. More automated shifts. He felt something unfamiliar then. Not panic. Not yet. But confusion. He emailed Daniel Brooks. Just checking in. I see a large portion moved to capital preservation. Is that expected? Daniel replied later that afternoon. Yes, Michael. The volatility trigger activated. This is normal within your strategy. It reduces downside exposure. We'll reassess once conditions stabilize. Reduces downside exposure. The words sounded correct. Responsible. Michael forwarded the email to Linda. See, he said that night. It's doing what it's designed to do. She nodded. If you're comfortable. He hesitated for half a second, then said, I am. The next week was worse. Headlines intensified. Market swings grew larger. But it was not a historic collapse. It was not 2008. It was sharp, but contained. And yet Michael's account kept slipping. 700,000, 680, 640. He did something he had not done in years. He calculated what the balance would have been had he remained in his old diversified index allocation. Rough estimate, rough math. The difference startled him. He closed the spreadsheet immediately. Comparisons during volatility distort perception, he told himself. Stick to the plan. That was the rule. On Thursday evening, Daniel sent a broader market update email to all clients. It was polished, reassuring. In turbulent periods, disciplined adherence to structured protection strategies is critical. Michael read it twice. Disciplined adherence. He had built his entire financial life on that principle. But something felt different now. The account had dropped below 600,000. Not catastrophic. Still salvageable. But the pace unnerved him. He called Daniel's office. Voicemail. He did not leave a message. He did not want to seem anxious. On Saturday morning, he logged in again. $593,000. He stared at the number longer than usual. Linda stood behind him. Is that bad? She asked quietly. It's temporary, he said. But his voice lacked its usual steadiness. That night, he could not sleep. He replayed the meeting from 12 years earlier in his mind. The charts, the words. You've built the mountain. Now we protect it. Protection should not feel like this. On Monday, the market surged upward in a relief rally. 3% in a single day. Michael felt a flicker of hope. He logged in after dinner. $598,000. Almost no movement. His chest tightened. He clicked into the allocation again. Now nearly 75% of the portfolio was in capital preservation holding. A small line beneath it caught his eye. Redemption subject to timing discretion under stabilization protocols. He read it twice. Timing discretion. He did not like the sound of that. He drafted another email. Daniel, I'm concerned the strategy isn't participating in rebounds. Can we discuss? No immediate response. Tuesday morning, the morning everything would break. He opened the account expecting to see stabilization. Instead, he saw cascading transactions, large liquidations, internal conversions, movement he did not authorize. And by the time the screen finished loading fully, the balance read just over $11,000. In the days and weeks that followed, Michael would piece together the mechanics, the triggers, the automatic exits, the locking structure that prevented re-entry during recovery windows. But in those final weeks before the collapse, the signs had been subtle. Professional language, automated emails, reassuring responses, nothing that screamed danger, just a system executing rules, rules he had agreed to, rules he had trusted, and rules that, once activated, did not pause for 9-month retirement timelines, or decades of discipline, or the quiet expectation of freedom. The signs had been there. He just did not recognize them as the beginning of the end. The word sounded harmless when Michael Turner first heard it. Trigger. It implied precision, control. a safeguard waiting quietly in the background. But a trigger does not ask questions. It does not consider timing. It does not care how close you are to retirement. It activates, and once it does, it follows instructions. 3 days before Michael's account collapsed, the market experienced what analysts later described as a volatility spike event. It was not the worst day in history. It was not a headline that would be remembered for decades, but it was sharp. Sharp enough. The index dropped nearly 4% in a single trading session. Volatility metrics surged beyond historical averages. Algorithms across institutions began recalibrating risk models. Inside the structured funds Michael owned, a threshold was crossed. The volatility trigger activated. This was not a human decision. Daniel Brooks did not press a button. No committee met in an emergency session. The mechanism had been coded years earlier into the structure of the fund. When volatility exceeded a specific band for a sustained period, the strategy would automatically shift into defensive posture. That shift involved selling equity exposure immediately and reallocating into capital preservation instruments. On paper, this was designed to prevent catastrophic drawdowns. But here was the part Michael had never fully understood. The trigger did not wait to see if the downturn deepened. It reacted instantly, and it reacted completely. When the threshold was breached, the fund liquidated large portions of its growth allocation near the bottom of the swing. Not because someone believed the market would not recover, but because the rules required action. Sell, convert, stabilize. By the end of that trading day, a majority of Michael's retirement portfolio had been moved into defensive holdings, short-duration instruments, cash equivalents, low-yield positions designed to preserve what remained. The next day, the market dropped again, another 2%. The strategy executed additional protective layers, more selling, more conversion. By the third day, nearly all growth exposure had been removed. The system had done exactly what it was built to do. But markets are rarely linear. On the fourth day, the market rebounded sharply. A relief rally. Institutional buyers stepped in. Headlines shifted from panic to optimism. 3% up, then another 2. Had Michael remained in his original diversified allocation, his account would have participated in the rebound. Not fully restored, but recovering. Instead, his portfolio sat in capital preservation mode, watching, frozen. The structure required a stabilization period before re-entering risk assets. It needed volatility metrics to remain below certain thresholds for a sustained window. Not hours, not days, weeks. During that waiting period, the strategy held defensive positions, and defensive positions do not rise during equity rebounds. Michael did not see this in real time. He only saw numbers moving in one direction, down, and then not moving up. On the morning of the collapse, the final mechanism executed. What remained of the growth allocation was liquidated under a clause called liquidity integrity enforcement. The language sounded abstract. It meant the fund was ensuring orderly redemption conditions during high volatility clusters. In practical terms, it meant this. The internal pricing mechanism adjusted under stress conditions. Assets were marked down aggressively to reflect exit costs and hedging unwind procedures. That adjustment rippled through participant accounts, including Michael's. When the dashboard loaded that morning, what he saw was not theft, not fraud, not a hacker. It was the cumulative result of layered automatic protections activating in sequence, each one individually defensible, collectively devastating. Later, when he spoke again with Daniel Brooks, he asked the question directly. Why didn't it move back in when the market bounced? Daniel's answer was calm. It's designed to avoid false recoveries. The model requires sustained stabilization before re-entry. But it sold at the bottom, Michael said. It sold during a volatility event, Daniel corrected gently. Michael understood something then that he had never considered before. Protection strategies do not predict the future. They respond to conditions, and responses can be mistimed. A week after the trigger event, markets had largely recovered their initial losses. But Michael's retirement account had not, because it was no longer positioned to recover. It was positioned to survive, and survival, in this structure, meant stepping aside entirely. There was one more element he had not understood. Re-entry was gradual, incremental. The strategy would not reallocate everything at once. It would move back in layers, if stabilization persisted. But stabilization is a luxury markets rarely provide. Small swings continued. Volatility remained elevated compared to historical norms. So the system waited, and waited, and waited, while inflation-adjusted losses became real losses, while time The one asset Michael no longer had in abundance moved forward. 9 months until retirement became 8 months and 3 weeks. 8 months and 2 weeks. Each day in capital preservation mode meant negligible growth, minimal yield, no meaningful participation in recovery. When Michael calculated what his account might have looked like under his old allocation, the number haunted him. Had he stayed diversified, even with the downturn, he would likely still have had over $700,000. Instead, after sequential trigger events, pricing adjustments, and defensive locking mechanisms, his balance had compressed violently, 82% down on paper, and effectively inaccessible for rapid recovery. The most painful realization came slowly. The strategy had not failed in the way a gamble fails. It had succeeded in executing its rules. Those rules simply did not align with his timeline. When he signed the documents 12 years earlier, he imagined a catastrophic crash, something dramatic, historic. He had not imagined a sharp but temporary volatility spike, triggering a cascade of automated exits. He had not imagined being locked out of recovery. He had not imagined watching a rebound from the sidelines. The trigger did not destroy his retirement overnight. It accelerated structural weaknesses already embedded in the design. Complexity layered over discipline, automation layered over trust. And once activated, there was no override button, no pause, no consideration for the porch swing in North Carolina. Just code executing logic. On the surface, the market event would fade from headlines within weeks. But for Michael Turner, it marked the end of a 36-year assumption that if you followed the rules, the system would protect you. The market eventually stabilized. News anchors moved on. Volatility charts flattened. Headlines shifted to earnings reports and election speculation. But inside Michael Turner's home, nothing felt stable. The morning after the collapse, he did not log into the account. He already knew the number. Just over $11,000. A lifetime of disciplined saving reduced to a figure that looked like a typo. Instead of opening his laptop, he sat at the kitchen table. It was early, still dark outside. The house was quiet except for the low hum of the refrigerator. Linda walked in a few minutes later. She knew by the way he was sitting, elbows on the table, hands clasped, that nothing had improved overnight. "Did it change?" she asked gently. He shook his head. They had coffee in silence. For years, the kitchen table had been where they planned vacations, discussed their son's college tuition, talked about where they might travel after retirement. Now it became something else, a place for recalculation. Michael pulled out a yellow legal pad. He had always preferred writing numbers by hand. It made them feel real. He wrote, mortgage balance, $142,000 monthly expenses, $4,300 Social Security estimated, not yet eligible Linda's part-time income, $1,200 per month. He stopped. Retirement in 9 months had assumed the portfolio would cover the gap. Now there was no gap coverage. There was a hole, a large one. "Maybe it's temporary," Linda said quietly. He wanted to believe that, but he had already spoken to Daniel Brooks again the previous afternoon. The funds were still in capital preservation mode. Re-entry would be gradual. Losses were realized. There was no mechanism to reverse what had happened. "This isn't coming back quickly?" Michael had asked. Daniel's pause before answering had told him everything. Recovery will depend on market conditions and time horizon. Time horizon. Michael was 62. Time was no longer theoretical. He flipped to a new page. Scenario A. Retire at 63 as planned. He ran the numbers. Impossible. Scenario B. Delay retirement 5 years. That meant working until 68. If his health held, if the company kept him, if no further surprises occurred. Even then, rebuilding from $11,000 would require aggressive saving, aggressive risk, at an age when risk tolerance was supposed to decrease. He drew a line through Scenario A. Linda watched him do it. Neither of them spoke. By mid-morning, he logged into his work computer. His inbox was full of routine emails, project updates, budget approvals, a retirement planning webinar reminder scheduled for next month. The irony stung. For years, he had been the calm one at the office, the steady presence, the man who reminded younger employees to contribute to their 401k. "Start early," he would say. "Time in the market matters." Now time felt like an adversary. Around noon, he received an email from Human Resources. Subject line, Retirement Transition Checklist. It had been sent automatically to employees within 1 year of their listed retirement date. He stared at it for a long time. Then he deleted it. That evening, he and Linda sat at the kitchen table again. this time with bank statements, credit card balances, insurance policies. They spoke in practical tones, not emotional ones. Practicality was easier. "We could downsize," Linda said. The word hung in the air. Downsize? They had chosen this house carefully. 3 bedrooms, a small yard, close to the park, where they imagined walking every morning after retirement. Selling it would mean admitting the plan had changed. "We'd still owe on this mortgage," Michael said. "And housing prices aren't predictable." Linda nodded. "What about part-time work after retirement?" He almost laughed. Retirement had just shifted from certainty to question mark. Now they were discussing working beyond retirement. "I might not retire at all," he said quietly. It was the first time he had said it out loud. The room felt smaller, not physically, emotionally. Linda reached across the table and touched his hand. "We'll figure it out." He appreciated her confidence. But inside, something fundamental had cracked. For decades, he had equated discipline with security. Work hard, save consistently, trust structured advice, avoid speculation. He had done all of it. And still, the next morning, he returned to the account dashboard. The number had not changed much. A few dollars of yield from capital preservation holdings. Insignificant. He opened the transaction history again. He scrolled slowly. The cascade of automated reallocations looked clinical, orderly, efficient. No emotion in the data. Just timestamps. He realized something unsettling. There had been no moment to intervene. No phone call asking for authorization. No warning labeled final notice. The system had acted faster than any human conversation could. Protection had become isolation. Isolation from risk. Isolation from recovery. Isolation from control. That afternoon, a colleague stopped by his office. "Counting down the months?" the colleague joked. "Must feel good." Michael forced a smile. Something like that. He did not explain. He was not ready to explain, because explaining would make it real. By the end of the week, the initial shock had settled into something heavier. Not panic, not anger, a quiet grief. Grief for the version of the future they had already imagined in detail. Morning walks, cross-country road trips, volunteering, time that belonged to them. Now time belonged to the rebuild. On Sunday evening, Linda asked a question neither of them had addressed directly. "Do you regret switching strategies?" Michael did not answer immediately. He thought about the meeting 12 years earlier. The charts, the confidence, the word protection repeated like a promise. "I regret not understanding it," he finally said. That felt more accurate. He had trusted complexity because it sounded sophisticated. He had assumed safeguards were inherently safe. He had believed that reducing risk meant reducing vulnerability. But vulnerability had simply changed shape. Instead of market swings, it had become structural rigidity. Instead of temporary losses, it had become permanent ones. As he turned off the kitchen light that night, he paused. 9 months until retirement had become undefined. There was no new date circled on the calendar, no revised celebration, just continuation. Work, rebuild, adjust, and beneath it all, a question forming quietly. If protection can erase decades of discipline, what else had he misunderstood? Michael Turner had always considered himself careful. He read contracts before signing them. He compared insurance policies. He asked questions during meetings. But now, sitting alone in his home office on a Tuesday evening, he realized there is a difference between reading something and understanding its consequences. He pulled out the original binder Daniel Brooks had given him 12 years earlier. The cover still looked professional. Dark blue, embossed lettering. Structured Retirement Protection Strategy. Inside were tabs. Overview. Allocation Framework. Risk Controls. Disclosure Statements. He had skimmed most of it back then. Focused on charts. Historical performance graphs. Downside mitigation scenarios. Now he turned directly to the section he had ignored before. Disclosure Statements. The font was smaller. Denser. Legal language. Paragraph after paragraph describing mechanisms he had never fully processed. He read slowly. Volatility-based reallocation protocols may result in rapid liquidation of growth assets during periods of elevated market stress. He paused. Rapid liquidation. That was exactly what had happened. He kept reading. Re-entry into risk assets shall be contingent upon predefined stabilization thresholds measured across multi-factor volatility bands. Multi-factor volatility bands. It sounded scientific, precise, but nowhere did it define how long stabilization might take. Days? Weeks? Months? Another paragraph caught his attention. Capital preservation allocations may include instruments subject to liquidity timing discretion under abnormal market conditions. Liquidity timing discretion. He leaned back in his chair. That phrase had appeared on his dashboard. At the time, it had sounded procedural. Now it sounded different. Discretion meant control, but not his control. He flipped to another section. Investor acknowledges that protective mechanisms prioritize structural integrity over short-term performance recovery. Structural integrity over short-term performance recovery. He read it again. The sentence was not hidden. It was there. Clear. Plain English. The system was built to survive stress events first. Recovery was secondary. Michael closed his eyes. He had assumed protection meant avoiding large losses. But the document described something else, avoiding catastrophic collapse at the system level. Even if individual participants experienced severe drawdowns, there was a difference, a painful one. The next day, he scheduled another call with Daniel Brooks. This time, his tone was different, measured, specific. "I've been reviewing the disclosure statements," Michael began. Daniel remained calm. "That's good," he said. "It's important to understand the structure." Michael flipped to a highlighted line. It says protective mechanisms prioritize structural integrity over short-term performance recovery. What does that mean in practical terms? Daniel did not hesitate. It means the strategy avoids whipsaw risk. During extreme volatility, it steps aside fully to prevent compounding losses. Re-entry is gradual to confirm stabilization. But if stabilization comes quickly, Michael asked, the rebound is missed. There can be opportunity cost, Daniel acknowledged. Opportunity cost, another clean phrase. Clean phrases for messy realities. Michael pressed further. Was there ever a scenario where this could result in losses greater than remaining diversified? Daniel paused. In certain volatility clusters, yes. Particularly if markets recover rapidly after a trigger event. Michael felt a tightening in his chest. That's what happened? Yes, Daniel said quietly. The word hung in the air. Yes, not denial, not evasion, just confirmation. After the call ended, Michael did something he had not done in years. He researched. He searched for academic papers on volatility-triggered strategies. He read articles about algorithmic risk controls. He discovered terms like volatility harvesting failure and forced de-risking cascades. He found examples of other funds experiencing similar patterns during sharp but temporary downturns. The pattern was consistent. When volatility spikes triggered full defensive repositioning, rapid rebounds left those strategies behind. Investors locked in losses. Recovery lagged, sometimes permanently. He sat back from his computer. This was not fraud. It was not incompetence. It was design. The strategy had been engineered for a specific type of catastrophe. A prolonged, grinding bear market, not a sharp V-shaped recovery. But markets do not announce which pattern they will follow. And investors close to retirement do not have the luxury of waiting for theoretical optimization. That evening, Linda joined him in the office. "Did you find anything?" she asked. He nodded slowly. It did exactly what it was built to do. "That's good, right?" He hesitated. "It depends on what you thought it was built to do." He explained the triggers, the stabilization thresholds, the gradual re-entry. Linda listened carefully. "So it protected against a crash," she said. "Yes, but we didn't have a crash." "No." They sat quietly. Protection against something that never fully materialized had cost them the recovery from something that did. Michael thought back to the meeting 12 years earlier. The presentation had emphasized the danger of another 2008, another prolonged collapse. He had anchored to that fear. Anchoring. He had read about it that afternoon. A behavioral bias, overweighting dramatic past events when evaluating future risk. He had built his retirement strategy around avoiding a repeat of one specific historical catastrophe. In doing so, he had exposed himself to a different vulnerability, rigidity. As the week progressed, he kept reading. One clause stood out more than the others. Investor assumes responsibility for alignment between personal time horizon and strategy design. Alignment between time horizon and strategy design. That line felt personal. 12 years ago, retirement had seemed distant. 12 years felt like enough buffer. But volatility does not schedule itself conveniently. Triggers do not care about proximity to retirement. The strategy did not know he had 9 months left. It only knew that volatility exceeded a threshold. On Friday evening, Michael closed the binder. For the first time since the collapse, he felt something other than shock. Clarity, painful clarity. He had not been reckless. He had not gambled. He had chosen a complex system without fully understanding its failure modes. He had trusted that professional language equaled safety. He had assumed that discipline alone insulated him from structural risk. And now he faced a new question. If complexity can hide risk in plain sight, what does rebuilding look like at 62? Clarity did not feel empowering. It felt heavy. Michael Turner now understood what had happened. He understood the trigger, the stabilization thresholds, the structural integrity clause. Understanding, however, did not restore $800,000. It simply removed illusion. On Monday morning, he opened a blank spreadsheet. Title, Rebuild Plan. He stared at the cursor, blinking for a long time before typing the first number. $11,482. The current account balance. He had stopped rounding. Rounding felt dishonest now. He listed assets. Savings account, $38,200. Checking, $6,400. Home equity, uncertain 401k, $11,482. Total liquid assets, barely enough to cover a year of expenses. For the first time in decades, Michael had to think not about optimizing retirement, but about protecting solvency. That afternoon, he scheduled a consultation with a fee-only financial planner. Not someone selling a strategy, not someone tied to structured products, just advice. The planner's name was Karen Liu. She had no polished presentation, no embossed binder, just a legal pad and direct questions. "What is your current income?" she asked. Michael told her. "How long can you continue working?" "At least 5 years, he said, "if my health holds." "What are your fixed expenses?" He handed her the list. She studied it carefully. Then she said something simple. "You're not bankrupt." He blinked. "I'm not?" "No," she said calmly. "You've experienced a severe portfolio loss. That's different from insolvency." The distinction mattered. Emotionally, it felt like collapse. Practically, it was a reset. Painful, but not terminal. Karen outlined 3 paths. Option 1. Continue working full-time until at least age 68. Increase contributions aggressively. Reduce expenses immediately. Invest in a low-cost diversified allocation without complex triggers. Option 2. Downsize the home within 2 years. Eliminate mortgage. Reduce monthly burn rate dramatically. Combine part-time work with delayed Social Security. Option 3. Hybrid. Work full-time 3 more years, then transition to consulting while gradually rebuilding. None of the options involved quick recovery. None promised restoration of the original plan. All required adjustment. "What would you do?" Michael asked. Karen paused. "At 62, time is your most limited resource. Simplicity is your ally now. Complexity already hurt you once." Simplicity. The word felt almost radical. No volatility triggers, no layered protocols. Just diversified index exposure. Transparent costs. Clear liquidity. Michael drove home in silence. That evening, he and Linda sat at the kitchen table again. But this time, the tone was different. Less shock, more strategy. "She says we're not ruined," he began. Linda exhaled slowly. "That's something." He walked her through the 3 options. They discussed downsizing seriously for the first time, not as defeat, but as recalibration. "We don't need 3 bedrooms, Linda said thoughtfully. The idea no longer felt like surrender. It felt practical. Michael realized something subtle. The dream of retirement had been tied to a specific number. $800,000. That number was gone. But retirement itself was not a single number. It was flexibility, health, time, and those variables still existed. Over the next month, they made changes. Small at first. Canceled subscriptions they rarely used. Reduced discretionary spending. Redirected every extra dollar into savings. Michael updated his retirement date in the company system. From 63 to 68. He did it quietly. No announcement. Just a change in a digital field. It felt like swallowing pride, but also like reclaiming agency. He rolled the remaining 401k balance into a simple low-cost index allocation. No structured overlays. No automatic exit bans. If the market fell, it would fall. If it rose, it would rise. Transparent. Understandable. One afternoon, a co-worker asked him casually, "Still planning to retire next year?" Michael smiled. Plans evolve. And for the first time since the collapse, he meant it without bitterness. Rebuilding at 62 is not about chasing what was lost. It is about preserving what remains. Health, income capacity, choice. Michael began walking every evening after dinner, not because it would restore the portfolio, but because it cleared his mind. He stopped replaying the trigger event, stopped imagining alternate histories. Instead, he focused on controllable variables: work performance, spending discipline, investment simplicity. Gradually, the sense of helplessness faded. In its place, came something quieter. Resilience, not the dramatic kind, not inspirational, just steady. The market fluctuated in the months that followed. Up 3%, down 2%. Michael checked his account less frequently. He understood now that volatility is not the enemy. Opacity is. 6 months after the collapse, the balance had grown modestly, not dramatically, but steadily. Each gain felt earned, transparent, understandable. One evening, Linda asked, "Do you still think about the old number?" He considered the question. "Sometimes," he admitted, "but I think more about what we still have." She squeezed his hand. For years, security had meant a specific financial milestone. Now it meant adaptability. The porch swing in North Carolina might not happen at 63. It might not happen in North Carolina at all. But it was not erased, just postponed, reimagined. And that realization changed something fundamental. The collapse had shattered certainty, but it had also stripped away illusion. Complex protection had promised control. Simplicity offered clarity. And clarity, Michael was learning, was a form of security too. 36 years is a long time to believe in something. Michael Turner had believed in the system, not blindly, but faithfully. Work hard. Save consistently. Avoid speculation. Trust structured advice. Stay disciplined. Those principles had shaped his entire adult life. And for most of that life, they had worked. That was what made the collapse so destabilizing. It wasn't just about money. It was about identity. For weeks after the trigger event, Michael replayed his past decisions, not obsessively, but quietly. In the car, in the shower, during long walks after dinner. Had he been naive? Too trusting? Too conservative? Too afraid of another 2008? He began to separate something important. The system had not betrayed him. It had behaved according to its design. What failed was his understanding of its design. That realization changed the narrative. It removed the villain. But it also removed the comfort of blame. Blame is easy, complex, comforting. Understanding is harder, more personal. He began noticing conversations differently. At work, younger colleagues talked about aggressive growth funds, crypto exposure, early retirement at 50. They spoke with confidence. Michael did not interrupt. He did not lecture. But internally, he understood something they did not yet feel. Time hides risk. When you are 40, volatility is abstract. When you are 62, volatility is personal. The distance between downturn and recovery shrinks. The margin for error narrows. He also noticed something else. Many of his peers believed safety meant complexity. Structured notes, buffered ETFs, managed volatility overlays. Language that sounded engineered, sophisticated, advanced. Michael recognized that tone now. It was the same tone he had trusted 12 years earlier. He did not think those strategies were evil. He no longer thought they were magical either. They were tools, and tools have trade-offs. What haunted him most was not the loss itself. It was the illusion of certainty. He had believed that if he followed every rule carefully, the outcome would be predictable. But markets are not reward systems for good behavior. They are ecosystems of probability, and probability does not respect personal timelines. One evening, sitting again at the kitchen table, he said something out loud that surprised even him. "I think I confused control with complexity." Linda looked up. "What do you mean?" "I thought more mechanisms meant more safety. But it just meant more moving parts. More moving parts, more failure modes, more scenarios he had never mentally simulated. Over time, the sharp pain of the loss dulled. Not because the money returned. It didn't. But because perspective widened. He still worked full-time, still adjusted contributions, still tracked expenses. But the anxiety that once accompanied every market headline began to fade. He no longer expected perfection from his strategy. He expected variability. And that shift was liberating. He also began to reflect on something deeper. Retirement had become a symbol. Freedom, rest, reward. But he realized something uncomfortable. He had postponed too much living in preparation for a perfect retirement. Vacations delayed, hobbies deferred, time rationed, always waiting for the number that was supposed to unlock life. Now the number was gone. And yet life continued. Mornings still arrived. Evenings still came. Linda still laughed at the same television shows. The porch swing dream had not vanished. It had just decoupled from a specific balance. One Sunday afternoon, he visited a former coworker who had retired modestly at 65. No massive portfolio, no complex strategies, just Social Security, a small pension, and disciplined budgeting. They sat on a simple back patio drinking iced tea. "Do you miss the bigger house?" Michael asked him. The coworker smiled. "I miss the idea of it sometimes. not the maintenance. They both laughed. Driving home, Michael felt something unexpected. Relief. Not relief that everything was fixed, but relief that retirement was not binary. It was not success or failure. It was adjustment. That night, he wrote a note to himself in a small journal he had started keeping. Security is not the absence of volatility. It is the ability to adapt. He underlined adapt twice. At 62, adaptation felt more powerful than prediction. If he could speak to his 45-year-old self now, he would not say, avoid risk. He would say, understand the structure of what you choose. If he could speak to someone 55 today, he would not say, be aggressive. He would say, know your timeline. Simplicity matters more than sophistication when time shrinks. And if he could speak to someone 9 months from retirement, he would say something even simpler. Ask what happens if the trigger activates tomorrow, because sometimes it does. The loss did not make him cynical. It made him precise. He no longer chased protection. He evaluated trade-offs. He no longer assumed professionals knew his timeline intuitively. He asked direct questions. And most importantly, he no longer believed that discipline alone guarantees outcome. Discipline improves probability. It does not eliminate uncertainty. That understanding, oddly, brought peace. There would still be market swings, still headlines, still volatility spikes, but he no longer expected the system to cushion every fall perfectly. He expected imperfection and prepared for it. As the months moved forward, his new retirement date, 68, no longer felt like punishment. It felt like a bridge, a path he could walk deliberately, not rushed, not forced, just steady. The porch swing might come later, but when it does, it will not represent flawless execution. It will represent resilience. And resilience, Michael now believed, was worth more than any volatility trigger. 5 years later, Michael Turner did retire. Not at 63. At 68, there was no dramatic countdown, no office party with a giant banner, just a quiet final Friday. He cleaned out his desk, returned his company badge, shook hands with colleagues who still assumed he had everything perfectly planned. In some ways he did, just not the way he once imagined. The retirement account had not magically recovered to $800,000. It never would, but it had grown steadily over 5 disciplined years. Simple allocation, low-cost index exposure, consistent contributions, no triggers, no layered mechanisms, no invisible thresholds. The number was smaller than the dream he once held, but it was real, understandable, liquid. He and Linda did sell the house, not in crisis, not under pressure, but by choice. They downsized to a smaller place in a quieter town. Less square footage, less maintenance, lower expenses, more flexibility. On the first morning in the new house, Michael sat on a modest wooden bench in the backyard. Not the wide white porch swing he once pictured in North Carolina. Just a simple bench under a tree. Linda brought coffee outside. They sat without speaking for a while. The air was cool, still, peaceful. 5 years earlier, he had believed retirement was a number, a milestone, a financial summit. Now he understood something different. Retirement is not an event. It is a transition, and transitions rarely look exactly like the brochure. The loss of his 401k had once felt like a personal failure. Now, with distance, it felt like an education. Expensive, yes. Painful, absolutely. But clarifying. He no longer saw markets as enemies or protectors. They were systems of motion, sometimes violent, sometimes generous, always indifferent. He no longer believed complexity equals safety. He no longer believed discipline guarantees outcome. He believed in alignment. Alignment between strategy and timeline. Alignment between risk and reality. Alignment between expectations and probability. One afternoon, about a year into retirement, a former coworker called him. I'm thinking about switching into something more protected, the coworker said. Markets feel unstable again. Michael did not panic. He did not project his story onto someone else. He asked one question. How close are you to needing the money? There was a pause. About 2 years, the coworker said. Michael nodded slowly, even though the coworker could not see him. Then make sure you understand exactly how the protection works, he replied, and what it might cost you if the market recovers quickly. He did not tell the entire story. He did not need to. The lesson was simple enough. Ask what happens if the trigger activates tomorrow. Ask what happens if recovery comes faster than the model expects. Ask how liquidity works under stress. Ask how long stabilization must last. Ask what capital preservation actually holds. Not because protection is wrong, but because trade-offs are real. That evening, after the phone call, Michael walked back to the backyard bench. The sun was setting, orange light across the grass. Linda joined him again. "Everything okay?" she asked. He smiled. "Yeah," he said, just remembering. He did not remember the exact number anymore. Not vividly. 800,000 had softened into abstraction. What he remembered clearly was the kitchen table, the yellow legal pad, the silence, and the decision to rebuild instead of surrender. If you had asked him at 62 whether he would ever feel steady again, he might have hesitated. Now he understood steadiness is not about avoiding loss. It is about surviving it without losing yourself. He still checks his account occasionally. Old habits fade slowly, but he does not stare at it. He does not measure identity by it. The porch swing dream changed shape. It became a smaller house, a simpler life, more intentional spending, more present mornings. The collapse did not destroy his retirement. It redesigned it. And perhaps that is the quiet truth many people approaching retirement never hear. You can do almost everything right and still encounter volatility you did not anticipate. You can choose carefully and still experience outcomes that feel unfair. The goal is not perfection. It is adaptability. It is clarity. It is resilience. As the light faded that evening, Michael leaned back on the bench and closed his eyes. He was not thinking about volatility bands or triggers or stabilization protocols. He was listening to the wind move through the trees. 5 years earlier, he had believed security meant control. Now he understood it meant flexibility. And in that understanding, there was peace. Not the peace of a flawless plan, but the peace of someone who rebuilt and kept going.